right, this is PookiesRevenge. I'm here with Anastasia for a Trading 101, formerly known as the Technical Thursdays. How's your week? How's everything going?
It's going good. How about you?
Good. So obviously we had some craziness in the market today. We had ISPO shot up over 600%. That was insane. So let's take a look at that one. And today I kind of wanted to bring things back to the basics because we have a lot of new members and a lot of people asking questions. And I think it's just it'll be good if we have a nice consolidated view of how we can trade things. So let me pull this open here really quick before we get into the actual trading stuff. And I also want to make sure I have the Facebook comments open so that I don't miss anyone's questions. So let's one in the background. Okay, cool. All right. So first thing we like to do, I'm just going to make the font a little bit bigger so we can all see it. When we have a portfolio, we want to take a portion of that and learn to trade. We don't want to use all of our life savings while we're learning to trade because that's how you lose money. And you shouldn't be losing your life savings because that defeats the purpose of calling it life savings. So, so while we're learning, if you have maybe $5,000 or $10,000, you can easily take 500 of that or 1,000 of that and learn to trade just as effectively as if you use the whole amount, but with a lot less stress. So what we'd like to do is let's just pretend that somebody is named Joe or Bob. We'll call him Bob. All right. Bob has, let's say Bob has $10,000 saved. Okay, Bob wants to learn how to trade. So Bob's going to take about 1,000 of that, or maybe 2,000 if he's feeling frisky. He's going to use 1,000 of that to learn with. Okay. We don't want to use the rest. We want to have that extra 9,000 sitting there for when we know how to put it to better use. And this is kind of a common pitfall with new traders. They want to just get in there and make money. That is not how the stock market is designed, and it is your money that someone else will be making. So don't do that to yourself. You need to learn. It's like starting a new job. You have to understand how the company works. You have to give it time. You have to be patient. You are essentially your own company in the stock market. You have to watch for expenses. You have to monitor your revenue and all that good stuff. Make sure you're going to be profitable. So how do we do that? The best way we can do it is to take that $1,000 and break it up even more, right? There are many different types of trades. You can do swing trades, you can do options, you can do long-term investments, or when I refer to swing trades, day trades, that's short-term speculative trades. You can do breakout trades, you can do momentum trades, day trades, scalps, all these different kinds of setups you can use. But the idea here is that you want to diversify and make sure that you are scaling your risk in proportion to your position size. So if you are taking something that's high risk, like a momentum trade, for example, your position size should be very, very small because it's a high risk, high reward system. And if it's a reward you want, that's great. But you're going to be consistent if you keep those position size scaled down nicely. Swings, they're a little bit slower. They're easier to read. You can kind of go a little bit bigger in your positions. So some general rules that we like to follow, and this is one that Tagman goes over very well if you haven't been on his streams. And that's to take about 10% of your portfolio and dedicate that to each position. Okay, so if you're just trading swings, this allows you to have up to 10 swing trades at a time. That's a lot for a new trader. We typically recommend having like 3 to 5, because if you can't do it with 3 to 5 positions, you're not going to be able to do it with 10. So in this case, that would leave, let's just say Bob grabs 5 swing trades at 10% each, or $100 each. Okay, that leaves him with $500 of his account on the side. Okay, if he wants to do some day trades, some options, stuff like that, he can always take 200 of that and throw it into the smaller, riskier trades. But it's important to just scale those positions down nice and small, especially when you're new, because if you grab something like this and it's moving dozens of percents on these candles, or if it's moving up triple digits for the day, it can just as easily move back down that fast. So you don't want to get caught in this turbulence with a lot of money on the line, because you're going to become very emotional and stressed very, very quickly. We've seen it. I've done it. Everyone in the market has done it pretty much if you've been there for a while. And you can see that kind of hostility taken out on other traders sometimes, like with the AMC apes and stuff, which I see both sides of it, but you really just want to take the emotions out of it. And, that's where having an objective plan comes into play. So once you figure out your position sizing, okay, let's say you want to take 5 swing trades, 10% each, so $100 each. You want to then break up each of those positions into smaller buys. So we teach 25, 25, 50. Those are percentages. So you want to take that $100 and you want to break it up into $25 buy, another $25 buy, and a $50 buy. And what that does, and I know poor Anastasia has already, she already knows all this stuff. So
it's so funny because I just did a TikTok on how to get the math for calculating everything down.
Did you? Okay, I'll have to watch that. Make sure you check out her TikTok, and let me also throw the.
I didn't post it yet. It's in the drafts.
Oh no, it's. I'll find it. Let me post the our link at the bottom of the page so that people can see where to join us. Okay, so if you've got, let me just draw these out here. You have $25 here, $25 here, and $50 here. Okay, and your first buy is $25. That stock can then go up, it can go down, or it can go sideways, right? Most new traders only accommodate for this scenario. They only think it's going to go up, and then that only happens 1 out of 3 times, right? We can tip the odds in our favor. We can grab uptrends. We can grab confirmations and stuff, but there's never any solid guarantee that it's going to go up. Okay, so you have to be prepared for all 3 of these scenarios and not just one. If it goes down and finds another level of support, another area of value, which I'll show you how to get to in a moment, then you see a confirmation down there, you place that second buy. Okay, and what that does is it takes your average from up here and it lowers it to down there. If these are equal size, it'll be right in the middle. If you offset them and make this one bigger, it'll be a little bit lower. There's a bunch of different ways we can trick that out. From here, your average is up here, so the price still has to get at least to your average before you break even. Okay, but from this point, the stock can again go up, down, or sideways. Okay, if it goes up, you can reduce your position size, or you can exit completely at break even, or you can let it ride above. Most importantly, you want to prioritize having this average over a big position if you're ever unsure. So if your average is right at a resistance level, you can always reduce it right at that level. I'll show you how to buy and sell here in a moment, but it's important to note that at this point, you're still only 50% in. Okay, so a lot of people at this point would like to set a stop loss, okay, because that means that once they commit this final 50%, they can no longer manage their average. And doing this will only place their average at the midpoint between the current average and this level here. So this is kind of your get out of jail free card. And we usually like to do this when the stock is on the way back up, okay? Because it's still probably going to be below your average. But if you see a nice strong confirmation right here, you slap that last buy in there, that brings your average down. And that's where you make your profit. And you start locking those profits in. I've drawn a bunch of crazy shapes to demonstrate this, so it has to make sense. It's just the way the world works. Let's erase all those. So hopefully that part makes sense. There's obviously 1,000 different ways you can break it up. Some people like to use 20%, 30%, 50%. Some people like to use 20, 33, 47. Some people like to use 10, 20, 30, 40, or there's all kinds of crazy combinations, 5, 10, 15, 20, 25, 25. It really just depends on you and your circumstances. Obviously, if you have commissions, you're not going to want to deal with multiple buys and sells. So you have to be careful with that. However, if you don't have commissions, such as we here in America are spoiled with Webull, we can buy as many times as we want. The trick is to not ever exceed this 10% limit on any position. Unless you're confident and have experience and can manage that risk, there's no need to hyper commit, which is where you commit more than your intended amount to any position. Okay. It's very tempting to want to hold on to a position and watch it drop 30, 40%. And then you're like, oh, I can just double my position down here, get a nice low average, blah, 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 blah. But at that point, this initial 10% that you've already dedicated is now hostage and you're paying more to get it back. So no bueno, right? You have a lot less control in that situation. So in the words of Mr. Miyagi, the best way to get out of that is no be there. Just don't throw your money at something and let it sit there if you're not comfortable or competent in doing so. Okay. I have the risk tolerance of a Zen monk. I don't care if something drops really far because I understand the future potential and I'm okay holding it for longer. But I also have the insight to recognize where there is potential and where there's not potential. So I'm not going to do this on, say, a Chinese stock that's going out of business and just got cracked down on with regulations and is already horrible at generating revenue, blah, 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 blah. We'll teach you all the DD stuff in time.
All that fun stuff.
Yeah. So yeah, step one, take all your money that you plan to trade with, set most of it aside. Okay, that's the best risk management tool you can possibly have in your arsenal. Then you take that and you break it up into even smaller amounts, and you determine how many of which types of trades you want to take, and you assign them each an allocation. And you don't modify that until you know what you're doing. Okay, this is the bread and butter of risk management. It's limiting your risk exposure based on the type of trade and the size of your position. If you exceed that, you're not consistent, you're not disciplined, and you're going to lose money more often than you win. Okay. And having this cash on the side is always good, just in case there's like a major drawdown in the market. You can take advantage of that. Okay. So when you have one position, you break it into smaller buys. Okay. And then you don't buy anything. Right? Just because you have settled funds, just because you figured out how much money you can throw at the market, don't. Just because you can doesn't mean you should, right? That there's a whole bunch of quotes I'm going to throw at you guys. They all have meaning. So you're probably going to be excited. You're going to see all the green candles, the red candles. You're going to see all the numbers going up and down. You're going to look at the profit channel and see people making thousands of percents or hundreds of percents, and you're going to want in on that. That is FOMO, and that's the best way to lose your money. Okay, so don't do that. So once you've gotten to that part and you've enrolled in the PennyBois University, so you can learn some stuff. There's some basics that you can look for before you place your buys and sells. So if you see an alert, as we talked about, we'd like to add it to a watch list. So if I look over here, I got these swings. Basically, I go through and I filter out the ones that don't fit my portfolio. So if I'm on, say, a $500 account, I'm not going to take a $300 stock because that means I'm already exceeding that 10% limit and I'm overcommitting, and that's going to be it's going to have more impact on my account one way or the other that I don't need to take. Okay. And if I'm on Webull, I'm not going to take a 90-cent stock because that means that I have to buy at least 100 shares. So you have to understand your circumstances. Okay. Once you filtered that out and you do all your due diligence on the stocks that you've decided are best for you, you've looked at FinViz, you've looked at the float, the volume, when their earnings are, you've identified all the catalysts that are coming up, which we'll teach you how to do. Then you can place some lines on your charts. Okay. And the charting is something I think a lot of people just go into too deep into the rabbit hole with. You only really need like one line. Okay. If it's a downtrend, okay, like this is a downtrend, you only need a resistance line because that's what needs to be broken in order for that downtrend to be broken into an uptrend. Okay. Until that happens, congrats, you're still in the downtrend. Okay. Once you break into an uptrend, then you draw your support line. Okay. That's as hard as it has to be. And then, of course, that's broken right here. Okay, you're in a downtrend. That's broken. Now you're in an uptrend. Congrats. You can just trade the uptrend. Now it's broken. So now we have to wait and see where this bottom is. And again, this is all part of trend trading before we can draw the resistance line to reverse this into an uptrend. Okay. But for right now, it's broken support. So there's no need for me to buy this right now. Okay. But before you get to all that, what we can do is we can look at the higher time frames, see where the price is turned around. And basically that's just looking for these little tops and bottoms and then drawing lines. Okay. It's not rocket science. It doesn't have to be too hard. And then you're just looking at areas where they have been tested multiple times. Okay. Like this right here, this line that it just came up and touched. We can identify, if we look to the left, that it was a strong area. There was a lot of participation over here. So we could expect people have probably been waiting here for a while to sell off their shares. Okay. So this is a level of contention. So we wouldn't want to hold our entire position through this level if we weren't confident. Okay. So this is why we want to sell off into strength on those uptrends, but it all starts with being able to identify your areas of potential value. So I'm going to erase all these. I'm on the weekly chart here. Okay, and the first and best thing you can do for yourself is go to the highest possible time frame, like the monthly or the weekly. and just plot those levels out. Okay, so like right here, it's touched. It was a resistance here and a support here, and it's a mild resistance there. So this kind of range right here is it's an area of potential. It's an area of value. Okay, and as well right here, we've touched this bottom 1, 2, 3, 4 times consistently, pulling up each time. Okay, so we were in an area of value right here. Okay, it's very easy to identify if you look at the higher time frames. Let me just erase that comment, put him in block. We get a lot of those spam account comments on here. Okay, so once you have your areas identified, I like to use the analogy of not jumping in front of a bus to stop it, but rather going to wait at the bus stop for the bus to slow down, let you on, and then pick a direction. So in this case, if we were watching Fisker, this is FSR, just as an example. This is the weekly chart. I've plotted out the levels. Okay, then we can look at the daily chart, and we can wait until the price comes down to this level. And we also have these minor levels that we can draw. Okay, and then we can identify areas within these where we can trade without drawing a bajillion lines, right? And then basically we just want to wait until the price comes down here rather than throwing all of our money at this. Let me get rid of this parabolic SR because it's kind of messing up the price action a little bit. There we go. Rather than throwing all of our money at this and trying to quote unquote catch the dip, buy the dip, because that is the best way to possibly lose your money. All you really have to look at is these areas that you've identified. Okay, and then once the price gets there, you see how it behaves, and then you determine whether or not it deserves some of your hard-earned money. Okay. And then once you have, like, let's say this is in a downtrend. Let's say we're looking at the 1 hour chart. Let's say it was back here, right? Just this little downtrend right here. Okay, perfect. So it's below here. It's in a downtrend. We see lower highs, lower lows. There's nothing exciting about this. Okay. Don't throw all your money at something that hasn't broken a resistance trend line yet, but rather we can keep our buys nice and small. We can put 5 or 10% here and there. When you see it really, really pull down, I'll teach you about impulses and correction here in a second. But once you see it really pull away from that resistance trend line, that's when you can kind of watch to see if it's going to pull back or if it's going to keep going. And again, we'll cover that in a second. But anything below this line here should be relatively small. So 5%, 10%, maybe 15%. That's it. And you don't want to go too far in too quickly. So once you hit about 50%, you know, a lot of people like to set their stop losses. A lot of people just like to wait and hold that 50% for that last buy. But don't fully commit on the way down. You want to wait until it shows some strength, find support. You know, if this money is being held ransom, you want to see a sign of life before you pay that ransom. You know what I mean? You don't want to just say, you don't want to take their word for it and be like, yeah, they're fine. Just give me the money. Because that's how you get more ransom taken.
Mm-hmm. Yep. Someone asked, how do you take profit on the way up? I feel like you just wait for confirmation, ride it up until the next resistance level, and just kind of hold.
Well, we're going to make that nice and objective right now. Okay.
Yeah. I mean, just like hold it until you see it hit resistance, you know, or have it like a stop, have a take profit right where the first resistance is.
Well, I'll show you.
Right up.
I'll show you exactly how I did it on XELA today. I did this on the live streams earlier, and I did it as I was walking through stuff today. What I like to do, actually, before we get into that, I need to talk about impulse and correction. Okay, so I'm just going to draw some stuff here real quick. So bear with me.
No, you're getting really good at that.
Thank you. I'm an artiste.
Artiste now.
Okay. So this is it's a portion of an uptrend. Okay, we have a higher high and a higher low, assuming that the lower high was over here and this is the higher low. So just assume that we have an uptrend here. Okay, this section right here is the impulse. Okay, this is where the strength of the move comes in. It's where most of the price action is covered. It's kind of like a jump in price. Okay, every impulse has a correction because people that bought down here are going to start taking profit. People that bought up here and see it kind of sputtering out are going to start to panic a little bit. They're going to sell. You know, no impulse is ever going to last forever. Okay, there has to be a cool off period. There has to be an exhaustion, and we can watch that exhaustion right here to determine whether or not it's a legitimate exhaustion and it's likely to continue up, or if it's a sell-off. If we see strong selling and it goes down far enough, it's a sell-off. There's no reason to hold that position. But we can break it down a little bit further, right? So what I like to do is on the smaller time frames, I like to move up a small stop loss underneath the individual candles in this, depending on if it's a strong impulse. And then I like to also move the bulk of my position up with the trend itself. So when I see higher highs, higher lows with a bullish confirmation, then I'll move my stop loss up for the remainder of my position underneath that. So let me, I'll illustrate here on XELA. Okay. Hopefully this will make sense. I'm going to try to make it make sense. Okay. So what you can see here on the 1 hour chart, obviously we were in, I think it was down here in the below 71 cents from the other day. But even if we got in this morning, it's no big deal, right? There's still plenty of price movement here. So let's just say our average is down here. Okay. Lee does a wonderful job of getting us in nice and low. So it's really good stuff. Okay. So there's, I like to call it 3 phases, right? So phase 1 is when you first buy, have your target and your second target. Okay. And these are pretty subjective. I mean, the shot callers do an amazing job of calling out areas that should hit, and most of the time they do. But I like to treat them more as guidelines, right? And that's kind of the advice, is that they should just be guidelines. So once we're in, we have a good spot, we can place a stop loss. Okay. And this is the bulk of our position, right? Because we can always reduce our position and add to it later, or we can exit completely and just start over. Okay. But for now, phase 1, we just have our entry. We have 2 targets and a stop loss. There's nothing else we can do at that point. We're in, we're committed. We assume that's it. Okay. However, once it starts to move up above our average, first we can move this up above our average and guarantee ourselves a profit, or at least break even. Okay. This is when we're starting to shift into phase 2. Once it's moved up a little bit, and once we see a strong impulse like this, what we can do is we can break this stop loss up into smaller stops. Okay, let me just use dotted lines for these. And we can follow these movements up. So hopefully you guys can see this on the screen. So as this pushes up, once we see a higher candle, once this candle here closes, we can just move our stop loss right below it. Once this candle closes, we can move our stop loss right below it. Once this candle closes, we can move our stop loss right below it. It kind of hovers here for a little bit, goes up, so we move our stop loss right below that. I'm just going to erase that target if I can. Sorry. So working from left to right, I'm basically just following the lows up on this smaller piece, maybe 10 or 20%. And then here it goes up. When that candle closes, you move it up. So right here, you would have sold out your first piece. Okay, maybe 10 or 20% of the position. Okay, if you're feeling aggressive, you could sell about 75% of that position. But within this, we have a, let me pull up the 15-minute on this. Within this, we have a, well, it's probably not the best example, but we have higher high, and then we have a higher low right here. So once this falls back, and then we see a push up from that level, this is when we can move the bulk of our stop loss up, right? Because we found a higher support and it's pushed up, okay? And then once you do that, you can do the same thing. Once you see that it's impulsive, you can place your stop losses here for another small piece. And this is how you can just consistently sell off your position into strength and not necessarily worry about it coming back to bite you. Okay. So it's going to snap to it. I got to turn the magnet off. So here it pushes up, forms a higher low here. So once this does that, and then it falls back here, hit your stop loss, you sell another small piece right there. Okay. But zooming back out, we see higher high, higher low, higher high, higher low, and then a push up from there. So you can move, again, the majority of your position up from that level. Okay. And then from here, you break off another piece into a smaller stop loss. And you're, again, just following the impulses. And this works really well with these kind of strong trends because right here, you put your stop loss. Next candle closes, move your stop loss up. And this is on the smaller piece. Candle closes here, you move your stop loss up. Candle closes here, you move your stop loss up. Up, 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 right? You guys get the idea? Up, 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 up. And then it comes back and hits it right there. You sell off another piece. So at this point, you would have probably sold 30 to 60% of your position, and you would then have the remainder of your position down here in a stop loss well above your average. Okay. So in this case, it's falling back down. You just kind of let it fall back down, let it exhaust for a little bit. There are strategies where you can time these. There's like TD sequential. We'll teach that in the PennyBois Advanced so that you can kind of watch these areas specifically. And then once you see it find support and push up, guess what? We move our stop loss up, right? And then this allows us to stay in the trade and lock in profits, all while letting the stock breathe, while just kind of slowly whittling away at our position. Okay, and the time frames that you use this on are completely dependent on the trade, but this is a rock solid strategy for newer traders. So again, you can see here we're getting an impulse. So you just follow these candles up, boom, 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 as they're closing. Right, candle closes, you move your stop loss up, hits right there, you sell another piece. Okay, so this is a good way to show off to your friends and be like, oh, I sold at the top, I sold at the top, I sold at the top, because you're just chasing the impulses up and you're selling as soon as it hits that exhaustion period. Okay, and you have your stop loss up here for when it finally fails that previous low, that previous support level. You could just exit your position completely and avoid the rest of the drawdown, and you've eliminated your risk exposure and made a good profit along the way. Okay, so hopefully that makes sense. You can do this on a lot of these stocks. It's great.
Mm-hmm.
Does that make sense?
Yeah.
Okay, because all you're doing, and this is the cool part, see an impulse up and a correction. Okay, you're just following this up until it hits this exhaustion. Okay, you're not trying to sell here thinking that's the top. You're not trying to sell here thinking it's the top. You're not trying to sell here thinking it's the top. You're actually waiting for the top to be validated by the exhaustion period. So once that happens, you can sell your piece and it's right there at the top. Okay, and if this makes sense, why not just flip it upside down? Right? And this is the cool part. And I think this is usually where a lot of people just go, oh my God. Because you can do this with your buys as well, right? Impulses are impulses and exhaustions are exhaustions. So when you see the price moving down really strong, when you see a strong impulsive sell-off, you can just wait. Don't try to buy the dip. Don't buy it on the way down. You wait until it finds a support and pulls up. That's when you start to place your buy. When you see a confirmation, you place a small buy. If it's below a trend line like that, that'll tell you what size buy you should be playing. We don't typically like to see major buys underneath these trend lines because it's still technically in a downtrend. There's still bearish pressure. So, we know that a downtrend is a series of lower highs, lower lows, right? And we know that an uptrend is higher high.
Almost.
Well, it's there. Okay. We know that an uptrend is a series of higher highs and higher lows. So downtrend, lower high, lower low, boom, 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 right? So if you were to watch this the same way that you would do with your buys, right? You would have your major buy level right here. We'll just make that yellow because it's easy. And then we'll send out small buys. Okay, so pretend this is entry right here, this yellow line, okay? This is your small buy, so you're looking to buy 5, 10, 15% max per buy, right? You're just following this down, 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 and then it finally bounces back up. You see a confirmation, you place your buy right there, okay? And then you dispatch another one, down, 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 right? And as soon as it finds a lower high, you can do that if you want it, okay? And then you just send down, 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 find support, pulls back up, place another small buy. Okay? And then when it pulls up, finds a lower high and starts to push down, you see that confirmation right there, continuing the downtrend. You can move your line down there. Okay, down, 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 down. Find support, bounces up, you place a buy. Okay, you're still technically in a downtrend at this point, so there's no reason to overcommit. And I wouldn't really chase this that aggressively to the downside in this market, but the opportunity is there. Okay. However, we know that this is the previous high, and this is now the current low. Okay. So what we have here is a higher high followed by a higher low, and this validates a reversal from a downtrend into an uptrend. And again, this is all taught in the education. So if I'm talking too fast or going through too many things too quickly, let me know, right? Because we're going to go through all this stuff over a couple of months. I'm just kind of crash course and get into here. Okay. And the entire time, I'm still not exceeding this 10% limit that I've allotted to this specific position. Okay. You don't want to overcommit and say, oh, it kept dropping, because if it keeps dropping and you're in too far, that means you're buying too aggressively. Okay. So once we have this reversal and you see that the higher high and higher low are validated, and you see a good confirmation right here, that's when you can place your final commitment with the remainder of your position. Set your stop loss right here. Right. And guess where we are? We're right back where we started before. We have our average somewhere, right? So it's somewhere in here. And we have targets. And a target up here somewhere. And these numbers are obviously just made up. I'm just doing it on the chart for drawing. I'm not looking at the price axis. So guess what? When the price goes up here, we move our stop loss up. When we see a higher, when we see a stronger push, that's when we start dispatching these smaller stops, right? We follow the impulse up. As it falls down, we sell, right? As the actual swing, the highs and lows of the actual trend finds higher support and pushes up from there, then you move the bigger piece of your stop loss up. And then from there, you just start dispatching these little guys, right? Follow it up, so it falls down. So right there at the top, you just do that over and over and over. And if it ever fails and falls down below one of these previous lows, you're out of the position, right? You lock your profits. You're still above your average, right? And you're good to go. And that's how you trade impulses and corrections. It's how you trade the trends, okay? So we've taken risk management from layer 1 all the way through the last layer, right? That should always supersede everything that you do in the stock market. We're learning how to trade on a smaller piece of our savings. We're not throwing the entire savings at it. We're then breaking that smaller amount down into a manageable piece that we can use to learn without losing or paying more than we have to learn the same exact lesson. We're taking about 5 to 7 swings, maybe 3 to 5 if you're busy. You don't want to overcommit, because if you're trying to do due diligence on all those stocks and keep up with the charts, it's going to be very time consuming if you don't know what you're doing. In time, you will develop a smart workflow and you'll be efficient and it'll take less time. But for now, if you're new, 3 to 5 swings is more than enough. You're still going to make money. You're still going to learn, and that's more important. And on top of that, you're going to save your money. Okay. And you still got plenty of cash on the side, just in case, you might need to pull something out. Maybe the IRS seizes all your bank account, but they don't hit your Weeble for whatever reason. Things happen, right? You got to just treat it like a savings account that you control the interest rate on. Okay. So for every one position, you want to break it into smaller buys. However you decide to do that is up to you. And then, the actual trading is the last part, right? Technical analysis is about 5% of trading. 90% of it is psychology and having discipline and building a trading plan. So if you can't do that, none of this means anything. So, if you're someone who's constantly looking to just throw money in the market, you're very impulsive, you need instant gratification, maybe avoid swings, maybe stick with day trades, but you have to still learn what you're doing and you still have to have a plan. You can't just do it and expect to be successful, because people like us, nothing personal, but we're the ones who end up taking your money, because we're the ones that are down here buying when we're more patient. And, newer traders are the ones that are buying down on the way down during the strong impulses. And that's, we hate to see that happen, but, there's so many people out there without any education, no guidance. They're throwing their life savings at these things. Retirees are throwing their money at the stock market. People are mortgaging their house. They're desperate. They're trying to make a profit, and they're being sold a dream that they don't know how to get to. So it's very dangerous for a lot of people. And that's why we exist. We want to help people succeed, and it all starts with education. And I like it. You got to have a plan. Yeah. You can have all the dreams in the world, but if you don't know how to get there, open the door and walk through it, you're just going to run into the wall a bunch of times. So yeah, if we look at like ISPO, for example, let's look at maybe the 3-minute chart. Yeah. And you always got to look at the time frame that you can interpret the best. You want to look at what's cleanest, most well-respected. So in this case, obviously this stock does not belong up here. It's going to fall down really hard. Hopefully everyone's out of it by now, or at least has locked in some significant profit. But let's say you got in this morning. I believe Amy alerted this one. I'm not sure if she did. If not, we've been watching it all day. It's a super low float stock. You can see the float is 17 million, low average volume, and it just became the place where everyone kind of conglomerated. So it's a self-fulfilling prophecy, right? You get a blood red market, and then you got a big bastion of green in there. People are going to flock to it. So that, of course, is going to drive up volume. We had a couple halts on it. So if we look at this one on the 5-minute chart, if this was our entry or somewhere down here, right? Could have even been up here. It doesn't matter. It's the same concept, okay? Let's just make this our stop loss. All right, now we're just going to walk through from left to right. So bam, big green impulse. We either got it or we didn't, right? Let's just assume that we did in this case. So, and of course, there's an exception to every rule. So if you see a big green candlestick like this, you can definitely still take some profit. Don't wait for the candle to come back down. The candle doesn't have to close. That's just a rule of thumb, okay? All right, so candle goes here, and you're just following this up. So maybe this was your first sell, right? Maybe on the close of that candle right there, when it came back down and hit your stop loss, maybe that was your first sell. Otherwise, it just keeps going. Oh, I forgot to move this up. So we can move it right here because it found support and pushed up, right? So as this is going, I'll just use the same line, okay? That candle closed, and I'll try to keep the mouse out of the way. This candle here closed, this candle closed, right? So I'm just following it up with a little piece. I just want to sell little pieces at a time, right? Follow this one up, right? Follow this one up, follow that one up, follow that one up, up, right? And then eventually, bam, right? That's your second sell, okay? At that point, that's pretty significant. I mean, you could just exit the position completely. That's 243%. Nobody's going to feel bad.
No, I would have 100% been out.
Right. But, the price does fall down, finds support, and pushes up. So at that point, you move this bad boy up, right? And then you just do the same thing. You just dispatch. Oh, I'll keep using this one. You just dispatch one of these little guys, and you can sell off pieces, right? And then just moving that out of the way. Then it comes up here, finds support, pushes up, right? So once you start seeing those confirmations, boop, 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 right? We're just going to follow this one all the way up. Maybe this one right here was your sell. Maybe you sold it a little bit, or maybe it was a little bit looser. It doesn't really matter because you're only selling little pieces, okay? And it's still way above your entry. Up, 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 up. So maybe this was another one. At this point, you'd probably be out of it. Anyway, I think most rational people would have probably just gotten out and then gotten back in if they decided it was worth it. And then up, 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 up. And then right there, that's your last candle. Right? But all the while, it's finding higher support. So you move your stop loss up, right? Higher support, bullish move, this big bullish greening. Oh, I just moved my stop loss. Don't hit escape on Weeble, guys. It does random things. So right here, we got a big green bullish engulfing candle. That could have been your final stop, and then you probably would have exited completely right there. Or maybe you kept your stop loss down here somewhere. It's finding support here. You might have set it down here. Doesn't really matter. It depends on how you trade, right? But ultimately, this is several 100% above your average. So again, don't beat yourself up if something goes higher after you chose to eliminate your risk exposure, because everyone who buys and sells and participates above there has higher risk than you, and you've locked in your profits. So don't feel bad. Yeah, and you just do this over and over and over and over again. And if you combine this with the insanely awesome alerts that like Lee and Amy and James and LT and Jackal and everybody that we have here puts out, and you find the ones that work best for you, and you can make them you can trade them the most efficiently, it's really hard to lose money. I think the market's been blood red, but we still have ways to put ourselves in really good positions. So if you're struggling, you can obviously join us. I mean, that's what we're here for. Does anyone have any questions or tickers they want to look at? Just throw them in the chat channel, the comments, and we'll
What percentage do you recommend like leaving on the table to ride up? I know, like for myself, like I'm at least 50% out in the first time it goes down.
Okay.
But then after that, how many times do you let it ride up, and how do you divide that up, I guess?
Well, an easy way to do that is just flip your buy-in method upside down. So if you do 25, 25, 50, you could sell 50% on that first pullback, and then 25%, and then 25%. If you do 10, 20, 30, 40, you could sell 40% right off the bat, 30%, 20%, and 10%. If you're a new trader, we want the least amount of money to travel the most distance, and the most amount of money to travel the least distance, because distance equates to risk. Okay. So if you're ever unsure, you can sell bigger portions on those for smaller percentages and lock in those profits more consistently. And there's a really cool aspect to that too, because if you have, let's say this is your average and this is where you sell it, blah, blah, blah. Okay. You've got your, this is your position. And let's just say I want to knock out 75% of that. Okay. And I'll just doop, and then there's 25% left. Okay. End. So say this is where you sell 75% and you still have 25%. This is your average. Okay. And you sell 75% up here for even, let's just say a 3% profit. Okay. That means that the remaining 25% now has a maximum drawdown of 9%, or 3 times that distance, before you break even or take a loss. Okay. And since you have a stop loss right here underneath the low, that is impossible as long as you respect the stop loss, right? So when you sell the majority of your position, even if it's a small percentage, you are guaranteeing yourself a profit as long as you have a stop loss within that maximum drawdown range that it allows. Okay, so you can absolutely do that. As a new trader, this is what we encourage. We encourage you to sell the bulk of your position at a lower price to get that risk off the table. Okay. If the stock has a lot of potential, you can roll it down into what I like to call a seedling. Okay, and let's look at ANY, for example. I'm just going to go to single chart here, and I'm going to slap some indicators on to squish the price. And let's look at the daily chart. Okay, so here we have, there we go. Here we have ANY, right? You can see it's kind of this choppiness into consolidation. So say you bought here, there's your average. Then you bought here, there's your second buy. Average is in the middle, but I offset mine. So mine is down here, right? Once it gets here, I can sell off everything from the second buy, take it off the table. And all that does is moves my first buy down to here, right? You just repeat the process over and over and over. It lowers that average. And then once the price gets above the average, take that second buy off the table. That just moves the first buy down yet again, right? Same thing. Goes down here, starts to reverse. Place that big buy in there. That moves that average down. Once it comes back up, take that big buy off the table. That moves the first buy down. Okay. Once it actually starts to reverse and you see confirmation, then, you know, if you do like 20, 33, 47%, you can just pile these all in there, set your stop loss for all or most of your position, and hope you're right. I'm just kidding. At that point, you'll see a confirmation. You will more than likely be right. You just have to do it the right way. And then as it goes up, you just sell off chunks of that, just as I've shown you. And this little piece right here is allowed to travel a lot farther because you are, you're okay for this to realize that full potential of the stock. Whereas these bigger buys, you don't necessarily want to have them go up here and then potentially go red, right? Because that doesn't feel good. So, you know, it's, if there's potential, then securing this average is my top priority. And I'm okay most of the time just leaving a 10 or 20% piece just to see where it goes. Because, you know, 20% here with a 650% profit potential is still pretty huge, right? I don't need this full position to experience that whole range because along the way, you can see we've got some drawdown, and that is potential for reversal to the downside. So in this case, it happened to go up, but, you know, after that, not so much, right? So you never know when the top is going to be. So there's no reason to let your full position ride. But if something has potential like this one, you can certainly let a small piece of it ride and just sell off the remainder of it the same way I just showed you with the stop losses and moving them up and breaking them up into pieces. So great question. I love it. I like questions.
And again, most important, have a plan, stick to it, and have your stop losses in.
Absolutely. And that's what it's all about.
And not just mental ones and hoping and praying.
Nope.
And wishing.
Gotta. Oh, what's that song? I can't remember it now. But yeah, you gotta have a plan. You hit it right on the head. If we look at the 5 minute on this bad boy, some people, maybe are moving their stop losses. They had a little stronger risk tolerance. Maybe they used a different time frame. Maybe they used a different set of indicators. You don't know when the tops or bottoms are going to be. So what you can do is just pay attention to the impulses and their corrections. Okay. And again, the stronger the correction, the stronger the impulse, you're going to have more volatility, right? So if you got this, and then you got one of these, and then it shoots up immediately, you're likely going to have a stronger sell-off in the future because all the people that didn't take profit right here are going to be waiting right here, right? They're going to have more friends. So don't necessarily want to get caught in that either. And that's where we can use things like Fib retracements, right? So we can measure the strength of this correction, this retracement. Think about it like if you're walking around in snow. If you walk away from your house and you want to go home and you've gone too far, you're going to follow your footprints back and go in the same direction you came. We can categorize this exhaustion and determine whether or not it's too strong, too weak, or just right. And then that can tell us how we can expect the continuation to go. I'm just going to erase all this based on the categorization of that sell-off or exhaustion, right?
Mm-hmm.
Okay, so everyone is now a master trader. You figured it all out.
Or make $1 million.
Make a bajillion. Don't sell early. I'm just kidding. Yeah, I mean, you can do this on all kinds of stocks. Like this is perfect for it. This ANGH one, perfect, because you keep seeing higher lows on these candles. So this is a great strong impulse. You're going to get situations where it's like this. It's just kind of choppy, and maybe get some situations like this. At that point, you just kind of blur your vision a little bit and pay attention to the actual trend instead of the individual candles, right?
Mm-hmm.
So if you don't have a nice clean one, pay attention to this. Because the buttons get in the way, right? So that's when you can just trade the trend and just pay attention to the higher highs, higher lows aspect of it. Okay? So, and then eventually you'll get one of these bad boys, and it's awesome. Yeah, so again, don't fixate too much on technical analysis and reading the charts and this indicator versus that indicator. There will be a point where you don't need any indicators. Indicators should only be used to confirm what you're already seeing. And if you're relying on indicators, you're doing it backwards. Okay. And again, ultimately, it's all about having this consistent position size management plan, and everything you do should be based on risk management. So if you're struggling, if you find yourself constantly selling too early, quote unquote, which is never a problem, you're not going to go broke selling early. You're choosing to prioritize risk management, and that's awesome. Pat yourself on the back. But if you'd like to make more, we're here. You can watch this video as many times as you want. It's on YouTube as well, I believe. I just put out the Facebook link, though. I'll pin this in the Discord, in the free live stream chat channel, as well as the Stock Talk channel for our premium members. And then you guys can watch this as many times as you want. If this seems like it was very complicated, I promise you this is intro level stuff. We teach a lot more, and it gets very complicated if you don't build into it properly. So, managing the actual money itself is one of the later stages. The primary stage is getting familiar with, obviously, the Discord. But ultimately, it's getting that psychology done. You have to understand what kind of person you are. You have to understand your habits, your impulses, your support and resistances. You have to find a workflow, develop a trading plan. Taking notes helps because you can study yourself literally just like a chart. If you can't do that stuff, you're not going to have a good time in the stock market. So it doesn't have to be work, but you got to put some work into it. Do you have any questions or anything you wanted to add to that before we jump off here?
No, just have a safe flight. I don't know what it's like by you, but it's crazy weather by me right now.
It's actually nice today. It's 54, but yesterday was like 15 or something. Everything is iced over still. It's weird.
Oh, that's us today. Yesterday was 60, then crazy rainstorms. Now it's snowing up to 10 inches.
Nice. Yeah. None of that matters. I nothing personal. I just tuned out. I heard trombones. I'm in Florida tomorrow.
Lucky you.
70s and 80s, boy. But yeah, so again, if you're struggling, or if you're new to trading, or if you've been trading for a while and you just can't figure it out and you're frustrated, reach out to us. We're here. We have the Discord. The link is at the bottom, or you could just go to pbalerts.com. We have a ton of free trading education. It's obviously edited and dressed up a little bit prettier than this. This is kind of a live stream, so there's no script here. We just wing it. I do live stream rants every single day. So if you can take notes, I guess, on that, you'll get a lot of information in a short period of time. I'll probably get in trouble. But yeah, I appreciate everyone hanging out, and I guess we'll call it a day.
Yeah. Have a safe flight.
Thank you. You enjoy your snow. I'm sorry.
You get it now.
All right, guys. Have a good day, and trade safe. Use your stop losses.
Stop losses and plans.
Always use protection.